We are live. The Hangout on Air is live, and good morning, happy Friday, welcome. Let's see those guns, let's flex them, let's stretch them, let's feel powerful.
Good morning.
Good morning.
Joining us for the first time ever. Peter, go ahead and introduce yourself since this is your first time.
Good morning, everyone. My name is Peter Cullen. I am a QuickBooks ProAdvisor in Irvine, California. I'm a 10-year ProAdvisor, and I'm very excited to be a part of this group.
Welcome.
Right, thank
Peter,
you.
aren't you one of the 100 people that were identified as top pro-advisors?
Yes, I am very, very thankful that I am one of those.
Congratulations.
Thank you. Thank you much.
Okay, so literally just before hitting the button to go live, Dennis brought up a topic. Dennis, you want to introduce the topic?
Well, since I live up in Microsoft's about 25 miles from where I live, and they're laying off like 18,000 people, apparently around 1,300 in the greater Seattle area. And I just think that it's kind of, my opinion, is the result of the internet, and they've been so used to cramming down changes on their customers, you know, like interface changes and operating system changes, that I think with Windows 8, you know, it's kind of like jumping the shark in terms of people just aren't buying what they're selling, and largely because of other options with the internet like Google. But I thought it was interesting that they're doing such a drastic move.
Yeah, it's, you know, and I was discussing with somebody this week. I'm not going to mention the company by name because it's really not confirmed. It's just what I heard from this other person. But that another large company that we're all, you know, acquainted with was laying off a lot of customer service people this week, and what that evolved into was the conversation about why. And a lot of times, from what we were discussing, and again, this is not even my opinion. I'm just sort of parroting what I've heard. But it seems to make sense, is that a lot of times these big companies will do layoffs, and it's more of a function of they've analyzed their financials, their fiscal year may have just closed, and they're looking to do things to make shareholders happy, so they have to lighten the load in order to improve their P&L and balance sheet in some cases. And so they lay off people in order to do that, which is very unfortunate, because what it says is that, you know, people's lives get affected by this, and now that many more people are going to struggle to make a living, if even be able to make a living at all because the corporate management of these big companies want to make their shareholders happy. I guess they're more concerned about the shareholders, who are probably sitting back with plenty of money in their pockets and not worrying about how they're going to, you know, get their next meal, as opposed to the employees who just got laid off, which are probably at the lower level wage earning, parts, so to speak. And of course, I'm surmising here, but you know, the point is that I think it's really unfortunate that companies do this just to basically play around with their balance sheet.
Beth, I want to agree with you, but Dennis, I absolutely agree with you. My experience the last year is I have been learning to live without Microsoft products, one product at a time, for various reasons.
Well, they alienated me with the Vista system, and I've been very unhappy with them ever since that. But to me, Gates was kind of like the visionary. Ballmer was kind of like a manager, and it's when companies are run by managers and they lose their vision, that's when they start getting in trouble. They start to stagnate.
Yeah. You know, as soon as Google started coming out with products that sort of competed with Microsoft, I started, you know, I was sort of an early adopter of that stuff. I certainly, and even in terms of Office products, I'm pushing people more and more that you've got to get into Google Sheets. Because Google Sheets will do just about everything that Excel can do, and a lot of things you never guessed that it could do, like pivot tables, and you can even do macros and things. And you know, and it adds the collaborative capabilities that just aren't there with Microsoft Excel, even if you're using Office 365 or SharePoint or any of the stuff that Microsoft has put in place in an effort to provide you with the collaboration platform. It's still not nearly as good and seamless. I mean, I've still yet to see any other company come up with collaboration that is as powerful as what you have with Google Docs. I've never seen it anywhere else, where I can literally in real time, the moment you make a change, see it happening.
Well, I think
Intuit is still in bed with Microsoft.
What's that?
Intuit is in bed with Microsoft. So
I'm just dying for Intuit to get a divorce from Internet Explorer already.
Yeah, exactly. Well, I think Microsoft, when they had dominance on the desktop, they could basically do a lot of cram downs in terms of forcing people to accept interface changes, and you had to relearn things and that kind of thing. I think as people have other options, they're resisting that. I know they're trying to get people to abandon Windows 7 now. Windows 7's only been out for like 3 years, maybe 4 years.
Yeah, well, I have to say, my newest computer, the one I'm running as we speak, is running Windows 8.1, and I have had no problems. I actually like it a lot. It took a little getting used to because it's like anything else. It's different. It looks and works a little different, but for one thing, it runs on the Windows 7 kernel, and once you figure out how to get there, it's not much different than Windows 7, really.
Yeah.
But I actually like the, I played around with the tiled screen, and I actually customized it to include the things that I use most often first, and now I'm finding I'm not even using that anymore because I have other tools that I use where I've set up the shortcuts to the things I like to access most frequently.
But for the average small company, that's a huge cost in terms of having their staff having to learn new things and, the inefficiencies. And so naturally people want to try to hang on, like look at Windows XP where people are still hanging on to that.
Yeah. No, I'm sure. Look, it's never going to be convenient, but I think especially, companies almost have to build into their budgets the fact that they're going to have to deal with this, that this is going to happen, The nice thing about using, again, products like what Google offers is even if using Google Apps for Business, the changes are going to happen for the most part seamlessly in the background. You're just going to log into Google Sheets one day and it's going to say, hey, there's new features. You want to see them, and they'll give you the tour. But
Right.
It's not a big leap. It's not like and now, Dennis, you're using an Android laptop, aren't you? A netbook, is it?
Actually, what I have is I'm thinking about buying a netbook or a Chromebook, but I haven't yet. I'm using a Nexus 7 for my tablet, and then I've got an Android phone. I got rid of my iPhone, and so I'm pretty hooked into. I don't use Outlook anymore for my calendar. I use Google Calendar because it's a lot more convenient and it's not as buggy as Outlook. So I pretty much I still use Excel, but I try to use Google Sheets as much as possible.
Mm-hmm. Yeah, no question. You're still going to use Excel for a long time to come, but as much as possible, same thing. I like to.
Let
use
me know if
Google.
they ever fix the wrapping problem.
I doubt it, because it's probably, you know what it is, Sarah, and I've been talking more and more to developers over the past year or two about this kind of thing in general, is these developers that work on these products, big company or small, they have to focus on what seems to be the problem that's affecting the most users. So if not enough people are...
that isn't a huge problem. I can't imagine.
Let's put it this way.
It's horrible for budgets when we upload, a budget, and I can't even find the numbers on financials or so far over to the right.
Yeah, my guess is if enough people were complaining about it, they'd make a priority and fix it. Because believe me, they're not out to crush their user base, but they have to address whatever is sort of the greatest in terms of the number of people complaining about it.
Yeah. Yep.
True. And that's what Google does. For Google.
Yeah.
Okay.
Yep. And
So-
Sarah, have you ever submitted feedback specifically about that to them?
Good idea.
There you go. See? So it could
They
be
have
that a lot
no
of people
idea
are
that
frustrated
I'm
about it.
bitching on a hangout. Yeah.
Yep. Exactly.
The squeaky wheel will get the oil. So start squeaking.
That's right.
I just get a bunch of email addresses and send separate emails. I think it's a mass movement.
Well, and that's just it. I mean, Intuit, QuickBooks Online, right at the top right, there's a feedback option. If there's something you don't see that you think should be there or something you see that you don't like, that's the place to go. And they do actually look at that and listen to the feedback.
I was on a QuickBooks Online webinar yesterday converting from desktop to ITO, and it's not as seamless as you would think, in terms of, it's almost like that'd be a real good specialty to have, converting desktop to QBO. You know who Joni Mann is?
Yeah, of course.
She had a really interesting article about QBO saying, okay, well, what happens when users outgrow QBO? Where do they go? And her solution was doing enterprise hosted.
Well, of course. That's self-serving, of course, because that's what she does.
But I mean, it was an interesting question to me because she said that about, what, 40% of the new users are starting with QBO. So what happens when you outgrow QBO? You go to
you have to go to, I suppose, Intact or something like that.
Yeah.
Right? That's going to be the next step up in the cloud world.
Yeah. So I thought that was an interesting article.
Now, this week, some of you know, I went down to San Diego and I presented on cash flow projections for the Bookkeepers Network of San Diego. And I was invited there by Ian Vason from Xero, and he was presenting on what they're rolling out in terms of reporting for Xero.
Oh, okay.
And they're going to roll out a lot of new reporting infrastructure by the end of this year, including the ability to add in a line and write formulas to do totals, or to really customize the reports. And so they're moving that. Sorry.
Like calculated fields.
Yeah.
Okay.
Yeah, where you can add a line to your P&L and put in a calculated field for like a gross profit. Which
like an if-then-else type of statement to create a field.
I don't know how sophisticated they're going to get with it yet, but then I asked Ian. I suggested to Ian, as I've suggested to some of the people that I've spoken to on the QuickBooks Online team, that reporting-wise, the ideal situation for me, my holy grail, would be to have something that functioned much like a pivot table, right? Where I would have my quadrants and I could drop in my values, my columns, my rows, and put one thing underneath another to get subtotals, and then have a quadrant for what I want to be able to filter by. And if I could have that kind of infrastructure built into the reporting module for any of these products, whoever can do that first wins, in my opinion, as far as reporting goes.
Sports had that functionality, but like we all know, they shut down.
I don't know. I never got to play with expanded reports, but I'm talking about something that's built into the product in their reporting area.
I was also reading last night on an article, something like Xero integrates with Google or Google Apps. Have you heard that?
Xero integrates with Google Apps. Oh, wow.
So you could probably create a pivot table that way, I suppose, and if you send your data.
No, all it is it's the same export that you would do to Excel. It will go into a Google Sheet. That's all. In your export options, you can choose Google Sheet. I mean, it's still a cool option, but it's not like I can do something that says, take what's in Xero and go right into a pivot table with it. You would have to dump a detailed report, like I've done videos on, and then make sure that report is structured in a way that it's very linear, so that then I can create the pivot table from there.
Okay.
But still, it's great because at least that way I could get from a report directly into Google Sheets. I mean, the reality is the other way is you download it into Excel, and it takes a minute to upload a spreadsheet from Excel into Google Sheets. But it saves you that extra step. And if the spreadsheet's very large, that process can take a few minutes. So. But the what he was what Ian as much as suggested to me that that's the direction they're going in Xero with their reports, is that it will be very much like being able to just literally customize your own reports by selecting your fields and organizing them any way you want, any which way you want.
That's what I've heard. That's what I was hearing about half a year ago, that was the plan, is to be able to have like calculated fields and be able to do customization.
Now, the other thing he told me this week that was interesting, I mean, he told the whole group, is that their next phase of converting from QuickBooks to Xero is going to be as simple as browsing to your QuickBooks company file, your desktop file on your computer, and then it takes everything from there. And he said it might take an hour or two to finish the process, but that it will be that simple to convert from QuickBooks Desktop into Xero.
And it'll keep all the transactions and everything? That's nice.
But only back 2 years. You can only go back 2 years. They won't go back further.
Are they going to have the same limitations that QBO has in terms of not converting certain pieces of data?
Payroll.
Memorize reports,
that's a nightmare.
Budgets, that kind of stuff.
Well, the payroll's a new add-on anyhow for them. So
from what he said, it sounds like you can go back 2 years, but everything will be intact for the 2 years.
Maybe not the payroll part,
It'll
though.
probably do payroll the same as QBO.
I mean, I'm imagining that the payroll, at least the payroll that's been booked historically, your payroll expenses will be there, your liabilities will come in,
Sure.
But they'll probably be regular checks or something.
Well, because they've only implemented the payroll recently, anyhow, in the last 3 to 6 months.
That's real complex right there.
Wouldn't that be interesting if Xero's conversion was easier than QBO's?
It probably
sounds
won't be.
like it's going that route, because in order for QBO to be as simple as that now, but if, again, there is that 2-year limitation now, and somebody asked Ian about that this week, and his response was, and I think it makes a lot of sense, is he drew on the old term garbage in, garbage out, right? So what did he mean by that? The further you go back in time, typically, the worse the data is.
Yeah.
And so in many cases, you're almost better off not having that old data. And the other thing is, and he said this to me, one-on-one when we were talking, and it makes sense. I'm no developer, but I know enough to be dangerous about how databases work. And the database structure is so different from even from the desktop version of QuickBooks to either online product, QBO or Xero, that it becomes very, very difficult from a programming standpoint to take that data in its original form and sort of repurpose it so that it conforms to the layout of the new database. So
I understand that with QuickBooks they had like a homegrown database, and then in 2006 they dumped it all into a SQL database. But I don't know if I'm not sure how much they normalized the data, how much
And again, even if it is all in SQL, it still can be structured differently because you have relational data tables, and the way they link to one another in one database is going to be very different compared with another one. So it's still very difficult to do a conversion like this.
Yeah.
And what he pointed out is the limitation of the 2 years. It goes to the fact that what you do import, you want to be imported properly. So I'd rather have 2 years imported properly than 10 years imported with a mess.
Yeah, and as a practical matter, you're not going to go back more than 2 years. I mean, for analysis, I wouldn't think.
In most cases, not. And you can still save your old database or dump it into Excel, if you need to, so that you have the data to refer back to when you need it.
Yeah.
Peter, you're quiet. What do you think? Do you have any clients in QBO, Xero?
I actually have clients in both, and I can tell you that we primarily use Xero for cash flow clients, meaning clients that all we really are doing is basically tracking cash. So when we set the client up, we sync all their bank accounts, we sync their credit card accounts, their PayPal, and then we're just monitoring cash flow. And so basically the goal there is to provide the client with the running cash flow statement, and it functions very well in that environment.
Gotcha.
For the QBO clients, we tend to try to do a lot more things there, because of course Intuit's trying to replicate as much as possible the desktop experience with the QBO product, even though it's not the same product. But we're trying to do more things there, like paying bills and doing customer billing and a little bit of job costing and other things. So we try to segregate the client base like that.
Right. That makes sense. That makes sense. And it's interesting. When I was going to do this presentation, I did it specifically around how to use the reporting from Xero to establish the infrastructure that I do in Excel in order to create the cash flow projections. And I was surprised to find out that they don't have an actual statement of cash flows yet, but Ian assures me that that's also going to be rolling out by the end of the year, I believe, along with the rest of the more robust reporting area. So
yeah, I can speak to the Xero side, because we do a lot of Xero clients, and the Xero reporting I don't think is anywhere near as good as QuickBooks.
No.
And I think they have a long way to go. And I think they've been talking about making changes to the way that they do their reporting and to provide more accountant-focused tools that accountants are really looking for. But I would, for me at this point, it's basically promise. I don't really buy much of what anybody says. I'm such a skeptic now that I really, it doesn't really. I don't pay much attention to what people say. I'm more interested in action. I think we're probably all a lot like that.
What they do.
Sure. So talk is cheap. I for one would love to see Xero do for groups like us and people like us, like what Intuit has done with the ProAdvisor program. I mean, I really think that Xero at this point doesn't really have a message that's compelling enough for ProAdvisors to either make the switch or to consider taking on Xero as a true competitor.
Right.
I have a friend who has an H&R Block franchise, and I was asking him about Xero, and he was down at the H&R Block training convention in Las Vegas, and apparently they're going to be offering Xero certification for the H&R people in these business centers. So I think that there's going to be at least an attempt to capture that market by H&R.
Well, remember that was news that broke a few months ago. We talked about that extensively when they announced that partnership. We're already past the point where we're supposed to be starting our demonstration, so I want to jump into that. Last week we started reviewing a QuickBooks file, and we spent a bunch of time up front. So for those of you who are watching, who may watch this recording, make sure you watch part 1, because we did spend a chunk of time talking about, I think, some really important stuff insofar as what Gina had brought up at the beginning of last week's Hangout about what we do when we're bringing in a new client and how we gather information about that client, the interview process, taking them in, finding out who they are, what they do, how they do it, and understanding how that translates into what the financials should look like. So with that, we had, by the time we got into the sort of demo part of it and really looking at how we review the file, and I'm going to start sharing my screen now, we really only got through the assets. We started getting a little bit into the liabilities. And we already saw, as we were going through this, how there's a very clear and direct relationship between what we're seeing on the balance sheet and how those items tie into stuff that's on the P&L, right? Accounts receivable, of course, ties directly into your sales or your income. The materials, cost of goods sold, tied directly in, right? All the inventory stuff. The prepaid insurance, of course, ties directly into our insurance expense. So all of this stuff is related, and that's why, in the audit or review process that CPA firms do, they say beat the heck out of the balance sheet, and by then most of the P&L has been cleaned up. And that's why, because the balance sheet is kind of the core. I like to sort of jokingly say, all the transactions eventually go to die on the balance sheet. Eventually, everything winds up going there to die.
I'm going to steal that, Seth.
Yeah, me too.
So, and it's true, because the net effect of all your income and expenses is going to close out right here, if you're seeing on my screen, to the net income line that's in the equity section of the balance sheet, right? So everything ultimately has to hit the balance sheet eventually, one way or another. So we were looking, and I think we started to talk about accounts payable and how to review that, but I'll just kind of start there this week. And similarly to the way we looked at accounts receivables is the way I look at payables. So we go into our vendables and payables report. I'm not going to double click the number. We talked a bit about that last week, how in some cases we don't double click the number because double clicking the number doesn't really get you good information necessarily, depending on the nature of the account, like undeposited funds. So we're going to go look at an AP aging summary probably to start with, right? And very similarly, and it's funny, where was I? I think it was actually when I was at this talk in San Diego. Ian was talking about this because it was about reporting, and he made the comment. It was very funny because it's very true that most business owners don't care about payables. They mostly just care about receivables, right? And that's the reality. They just want to know, when am I getting my money? They don't care about the money they have to pay out, as long as it's not to the point where they're getting into trouble or having their credit affected by it. So we look at a report like the payables report, and of course in the sample file everything looks nice and neat and everything's in the current category. But
yeah, I don't see any negative numbers there, Seth.
No negative numbers. So
my clients.
Yeah, exactly.
5-year-old bills.
And so let's talk about that. The kind of stuff we often do find here, we will find negative numbers. What does that mean? In many cases, what you'll see it's actually a bill payment, which means that at some point in time, it probably was tied to a bill, but somebody who didn't know better or wasn't paying attention to what they were doing deleted the bill, leaving a payment affecting accounts payable and causing a negative balance in accounts payable. Or they actually just wrote a check through accounts payable for the vendor, maybe because they knew they were prepaying, maybe and then the bill never got entered, so it just got left there, hanging out in the balance. So we see those things. That's what we're looking for, so we can ask the business owner questions. Because remember, every business owner going into this process is going to swear that their books are, well, I shouldn't say that, but a lot of them are going to swear that their books are in perfect shape. A lot of them are coming to us because they know they're not, but oftentimes it's still, they don't think it's nearly as bad as it is. And so they get shocked when they see something that's in the 61 to 90 day category and it's negative, and they say, well, how could that be? And you show them. Now at that point, then I usually don't even bother to double click from here. At that point, I'm just going to go in and run an unpaid bills detail, right? Because this will show me very clearly by vendor, what's going on with each one. So that this is where I'll go and show them, hey, see, there's a bill payment here. It's negative, and that means that it's missing a bill. It needs a bill to go with it. So how do we fix that? We either enter a bill, we enter it in the current period because we don't want to affect prior periods where returns have already been filed, or we can book a journal entry, whatever we feel is more appropriate. But certainly if they know, oh yeah, there's definitely a bill for that, and we know who the bill was to and what it was for, then you just enter a bill and apply the credit, and it's cleaned up. Right, and so a lot of times, as a part of this process, I'll leave the business owner with this as kind of a homework assignment. And I'll say, all right, if need be, I can dump this into Excel for you and go through the spreadsheet and go research any of these items. And again, I won't do it from this report. I'll do it from the unpaid bills detail.
I add a couple other columns to that report, Seth.
What do you add?
I add, see, that's just showing what's due on a bill. It may not be the original bill amount, which maybe it will make more sense to the owner to say, look, the bill was partially paid and we never finished paying for a partial bill. So I'll add the amount and maybe the balance, running balance, and a memo field.
Yep. You know what else I always do, which I'm glad you stopped me because I would have neglected to mention this, is I always, instead of just showing the amount, I go debit, credit instead of amount, because this way it splits it up and it's clearer to see, here are the bills, here are the bill payments.
Right.
Good
Yep.
point.
Yep.
Good point.
The other thing is you want to tell them that this does affect the profit and loss. Changes you make here will definitely be reflected in the expense section on your profit and loss.
Definitely, without a doubt. So, Sierra, all excellent points. You want to make sure that what you're showing them here. But does this report, if this bill was partially paid, I think this report still shows the full amount because it shows the bill, and then here it shows the payment.
Not the one, not the canned one. Pull up, when you just pull up the canned one, it just shows what's open.
This is the vendor balance detail. You're right.
Yeah, no, you're in the wrong. Yeah.
Yeah. If I just show the unpaid bills detail, you're absolutely right. Sarah is always right.
So you tweak it a little bit.
Yeah. So here,
keep it, you can. Some of these reports, you want to get a fresh one each time, so.
But you can show. Isn't there a column available for the original amount, or that's only from running out of cash?
Yeah, right there, amount. Debit and credit or amount will give it to you. You had it.
Yeah.
Yeah, you had it. If you want your debit and credit, you can do that instead.
Okay. Well, here the debit and credit doesn't really apply because this isn't going to show payments. It's only going to show bills because it's by virtue of what it is. It's only showing open balances.
It'll show a bill payment on there if it hasn't
show
been
a partial
applied
payment?
and the bill's been deleted. Sure will.
See, I've never gone to this extent with this report before. Pretty sneaky, sis. Cool. I like it, Sarah. All right, so let's test Sarah's theory. Let's do a partial payment on.
Well, they go down to the bottom. Yeah, or I'll go down to the bottom and see if the open balance is the same as the amount. Then I don't have anything weird going on. But chances are you've got different.
Got it. So let's do a partial payment real quick.
Yeah.
Kaler's Hardware.
Or you'll find a bill that's dated in the future and the check is dated in the current period, and then that's why you're seeing a negative.
Okay, so here it is, open balance, $1,470. I paid $3,000, $44.70. It doesn't show the payment though, separately. It just shows
you
the
applied
difference.
it. Oh.
Oh, that's true. So if I don't apply it,
let me think.
All right, let's test that theory. That's what I love about this.
It's going to apply it automatically on a bill payment. I'm thinking AR.
But I can go unapply it.
Can you?
You know why? Because I'm magical when it comes to QuickBooks. Sure, I just come in here and uncheck it.
Yeah, exactly. No, but the amount due and the original amount should be different. Why
No, they are. They are different. No question about that. Actually, when I unapply it, now it shows the whole amount due. it doesn't reflect that there is a payment out there for $3,000.
Well, wait a minute. Then it would be out of balance.
But it's got to be applied to a bill. No, because this is only showing. It's interesting to look at this way. This is only showing open balances, right?
It's not the accounts payable.
Right. It's not true accounts payable. It's just bills and whatever's due on that bill.
You can customize report and uncheck that where it says status.
Yeah.
If you can do it that way.
Okay, so that's not matching accounts payable now.
Correct.
Right.
Correct.
No.
Under filters.
Yeah, something's wrong with the.
Okay.
So page status is open. So if I choose either,
right, say either, right?
but that's going to be the same as a vendor balance detail now, I believe.
Which is what you.
Although no, the 3,000 doesn't show up.
Show it again.
But where's my $3,000 payment that I issued? It still has to be applied to something in order to show up here. So now if I find that,
did you do it?
watch this. If I find the 3,000 and reapply it, where did it go? Which way did it go?
Go to your checkbook. What'd you date it?
Boo boo. Well, let me just see if the credit's available to be applied if I just go into pay bills.
Well, you can use CDR as well to find it. Client data review.
So if I go here, it looks like it might have effectively deleted the whole payment because look, there's no credits available even. So
It is magical.
But
Go to the payable center and poke on the.
no, it's gone. It's definitely gone because there would be a credit here.
Confusing people. We're going in the back door and it's like start at the beginning.
Oh,
Right, so now my 3,000 shows
You
it
know
up
too
here.
much.
Exactly. Well, now we're just playing, but this is good. I think this is good for people to see and understand that you can go and play around. Just back up your file before you start playing around like this.
Yeah.
But this is how you troubleshoot. You just start, go, some go left, some go right, but.
And this is
it's
how you.
so magical it disappeared.
This is how you hang yourself.
Yeah.
Be careful of date.
Oh, yeah. It's a date system.
That's
It's a
right.
big database, date run.
Especially if you have it set to use the same transaction date as the last transaction instead of
Oh, yeah.
date.
I had somebody email me, I think it was yesterday, with a question. She said that she was running a balance sheet, and for some reason, the accounts receivable or payable, I forget which, but it was way off from what it showed, like in the chart of accounts where it shows the balance. And the first thing I said was check your dates, and sure enough, that's what it was. She was running the balance sheet as of a balance sheet date previous to today, and so as of that date, it showed, of course, what was payable then. So, but this is how you can review accounts payable, and it doesn't really help much to double-click it, because then I just get this, which I could total this by vendor, and that will give me some helpful information. In fact, where this helps is when I'm running a cash basis balance sheet and I get amounts still showing up in payables because QuickBooks doesn't do a very good job of reversing items that affect only the balance sheet when it goes from accrual to cash. So that's something I do there. If I'm trying to do year-end financials that are on a cash basis, I do double-click accounts payable and total it by vendor just as I've done here. And this way, on a cash basis, you'll be able to quickly identify where the amounts are coming from that are showing up on the cash basis balance sheet. And then you can either make adjustments and reverse them, or you can at least what I've done is I've dumped them into Excel and then sent them to the tax preparer and said, here's where this difference is coming from. Handle it however you like. A lot of times it's things like customer deposits that weren't used by the end of the year. So I have a liability on the balance sheet that's in there by virtue of an invoice that I posted, and so it doesn't know how to reverse that properly going to cash basis. So that's how you kind of beat up accounts payable and make sure that it is what it should be. And it also helps to understand a little bit about auditing procedures and what we call the management assertions that are inherent in something like the balance sheet. When you're looking at something like accounts payable, what you're looking for is valuation. Is it really valued properly at $90,688? You're looking for existence. Does it exist? Do we really owe this money? Right? It's things like that that help, if you can think about it in those terms, to understand how to put together a balance sheet that is accurate and reliable and that fairly represents the financial position of the company as of the balance sheet date. Here we have, moving along, my credit card. right? What's on my credit card? Well, first of all, I hate the name My Credit Card. I want it to be called like American Express Blue 1234, right? So I know which card and which account number we're talking about here.
Because nobody just has one credit card.
And even if they do, I still like to know for sure that I'm looking at the right one, you know.
Oh, absolutely, and I do that last 4 digits of the account number too.
Yep.
For bank accounts too.
Well,
And then while we're at it, I also stick in their social security number and their online PIN just right there in the account. And I publish it on Facebook.
Nice.
No, just
No, what I do, the one thing I add to that though is I add the 4 digits on a debit card as well in case of the debit card charge versus the operating account, the last 4 of the operating account and the last 4 of the debit card. So in case you're comparing 2 different things.
On the vendor name?
For the bank account or the credit card, or well,
I do that sometimes. So you'll have like Bank of America and the last 4 of the account number / the last 4 of the debit card number.
Correct. Yeah. That's
But what if you have several debit card holders? Then you have all these different numbers on there.
Well, you should.
Would you put like DR and then the 4 digits in the name?
Yeah.
The debit card.
Yeah.
As opposed to credit card. I mean, just leave.
Well, it's going to be on the operating account. So
yeah, the debit card's going to be the bank account. And that's something I come into a lot. We didn't talk about this last week, but a lot of clients don't understand that the debit card is not its own account. It's tied directly into the bank account. So I've seen that a lot on the books where you'll have the bank account, and then you'll have an account based on the debit card that has just the debit card transaction. So be aware of that. And, you know, guess what? That means, and then imagine then the bank account is actually reconciled. Now you know you have a mess. Exactly. But it's important, you know, it's important for people watching, especially bookkeepers, especially if you're just starting out and you don't have these kinds of experiences like we have, to understand what's wrong with that picture, right? To understand why, if a bank account is reconciled, but I have debit card transactions in a separate account register on the balance sheet, exactly like Sarah says, how? How could you possibly be reconciled? At that point, I'm saying...
Reconciliation discrepancy account.
Yeah, that's what you look for next. Or you check into the open balance equity, because that's where a lot of stuff often gets dumped. So bottom line is we're going to merge those 2 accounts, which is going to undo all the reconciliations, and we're going to start all over with the reconciliation process for sure at that point. So, you know, again, my credit card, this one I'll go actually into the register. So I won't even double-click it from the report, but I'll go into the chart of accounts, and I'll go into the credit card here and double-click it from the chart of accounts so I can get right into the actual credit card register. Mm-hmm. And this way I can see what's going on. Of course, I'm looking to see where do these check marks stop, right? And then if I didn't do it when I looked at the bank accounts, I'm certainly going to check to see when this credit card was last reconciled. Mm-hmm. And this is another thing a lot of clients don't know, that credit card accounts need to get reconciled just like bank accounts do. So I'm checking for that. And at the end of the day, I'm going to have them give me the last supposedly reconciled credit card statement and compare that beginning balance and make sure everything lines up the way it should. And if not, then that's another homework assignment. Okay, client, I need you to go back. I need you to re-enter, re-reconcile every account every month. And if you want me to do it, I can do it. It's going to cost you. You know, that's kind of how I approach this. We talked about this last week, too, a little bit, that, you know, do I do it or do I put... I try and put as much back on them to do as possible because, again, I don't want them spending money with me doing this kind of work. I want them spending money with me doing much more valuable stuff.
Yeah, theory. Now, what happens if you don't see the credit card?
Well, and that's where we talk about existence, right? Does it exist? Is everything that existed reflected here? But where you're going to... You're going to find that when you go through the bank account, though, because you're going to see payments to the credit card, hopefully.
I see, again, negative amounts under the credit card. I will see credit cards and then huge negative amount.
Sure.
Because paying the bill and not posting the charge. Yeah.
Which means they probably booked payments and haven't been keeping up with the charges. Exactly.
They're behind.
And so, you know, so the bottom line is usually I'll find out about credit cards that should be on the books and aren't as I'm going through the banking, because I'll see the payments and I'll see a payment to a credit card and I'll say, hey, was this a personal credit card or was this for the business? And they'll say, oh, it was for the business. And I'll say, well, why isn't that on the books? You know, and then then that's another homework assignment. Well, we've got to get that credit card on the books. We've got to start entering and reconciling that statement and get that caught up to date. Because we're missing, I tell them, so what this means is that our expenses are understated because you have stuff you charge on that credit card, which means and this is how you get the client motivated to do something about it, is you say, you're overpaying your taxes because you don't have the expenses there that should be. Mm-hmm. So
you know, one of the arguments I hear is, but my boss wants to see it on the accounts payable list. He wants me to put it in as a bill. And technically, a credit card, the charge is when it's deductible, not when the credit card is paid, because it's actually a loan at that point. So it's properly classified as a current liability, and it's not a trade payable. Right. So and you lose other things. I tell them you lose the date of the charge, you lose the vendor name. There's a lot of reasons to not run it through accounts payable. You know, if you have to drop your accounts payable aging, print it out and handwrite it. You know, there's ways to get your boss happy without.
Usually at that point,
using the
I'm
system
saying,
the way it's
can I
designed.
talk to your boss? I need to talk to your boss for 5 minutes because I can explain it to them what they're missing out on by doing it that way. And at the end of the day, I tell them, look, the reason they want it on accounts payable is because they want to see it in their payables. And I tell them, then that's when I teach them how to look at the balance sheet, because then if you're looking at the balance sheet, I can say, hey, Mr. Boss, just take the accounts payable amount here plus the credit card amount here, and that's your liability. That's why they mostly want it on in accounts payable, is they want to see at a glance what their true total liability is, and so that's how you solve that problem.
Yeah, except the ones that want to know what I have to pay this week.
Can you get an agent analysis on the credit card payable?
No, I don't think. No, you can't get an aging analysis. I mean, you can get a report. What I do is similar to how I run a bank account register. I can run a credit card account register report. Right, so they can see the recent charges. In fact, I often include that in the weekly reports that go out to clients, is a report that shows them since last week everything that went on the credit card. And that's good for a number of reasons. The biggest one is probably the fact that they want to be able to see that everything that's in there that was charged in the past week is legit, right? And they want to make sure there's nothing on it shouldn't be. So the business owners like to see that, I've found. So I often include that. I include a check register report and I include a credit card register report in the set of weekly reports that go out.
So when the employee puts a charge on there for Yahoo Personals, the owner gets to see it.
Exactly. Well, you want to hear a funny story about that. See, when I double-click this, because this is run for all dates, it shows everything. But if I just drop this down and say, you know what, just show me last week, in this case it shows nothing because we're in a sample file that's in the future. But let's just say I do this fiscal year. Happens to also be everything. So let's push this forward a few months because there's something specific I'm trying to get at here. Let's start from April 30th. You see what it does when you run it off the balance sheet like this is it gives you the trailing balance so that you have a report. Whereas if I just go run a custom transaction detail report and filter it for the credit card, it won't do that. It will just give you the activity for the date range that I've set, which means my balance won't be accurate. So it's important to understand why it's important to run this off the balance sheet directly. But what I'll do is I'll give them something like this, and you're exactly right. And I'll tell you a funny story about this. This is you're going to get a laugh. I'm going to turn off my screen share for a minute. So I'm at a client. I was fairly new to the client. Right, this was years ago when I was brand new as a consultant, and so I'm going through and I'm noticing they have a lot of credit card debt on the book, so I'm going through and I start putting together a table showing all the different credit cards and what the interest rates were to show them how much they were spending on interest and to make the sort of argument to the owner that, hey, we should really work on getting these credit cards paid down, because it was clear that he wasn't. He was just paying the minimums and using them. And so as I'm putting this together, we're going through the charges and we're finding out what things were, and I see a charge to some name I didn't recognize. It was one of those that it just wasn't clear what it was for. And so I brought it to the bookkeeper, and she says, I have no idea what that is, and she usually knew what everything was. So eventually we had to, I think there was like a phone number or a website address in the description or something, so we had to go that far to research to find out what it was. And by this time, by the way, we went to both owners. It was owned by two different guys. It was a commercial plumbing company, and both guys said, I have no idea what it was, but this was one of these deals where they had different card holders on the account. So we were able to trace it back to one of the two owners, and as it turned out, the charge was for an adult internet site.
Entertainment.
Wow.
When we showed it to this guy, his face turned such a shade of red.
It's the wrong card.
I actually felt bad. He sure did.
Does he have a wife you could have found out? Or?
He had a girlfriend at the time. I think they've since married, but it was so funny because it was like that was like, and I was, like I said, I was new to this, so I didn't even know quite how to react or deal with the situation. I was embarrassed for him. I was like, "Oops, sorry," you know, and he was the one who hired me.
I could just see explain that in an IRS audit. That'd be interesting.
Yeah, really. Oh, it's entertainment expense.
Yeah.
Marketing.
Those gals need their taxes done.
Yeah.
They need plumbing. That's what it is. They might need some plumbing.
We're casting a wide net with all our services.
Yeah, well, internet porn deals with plumbing on a certain level.
We don't know where our customers are going to come, where they're going to come from. Good
We let them use one of our construction sites to film us. Anyway.
If we have, as advisors, don't see source documents or we're working online and we don't have access to source documents, I do a lot of Googling. I'll see a vendor name I don't recognize and
I do
on
that.
Mother Monitor and Google and go.
I have come across things in my travels as an accountant going through people's transactions and where they spent their money and what on, and I have learned things I just never wanted to know about people.
Yeah.
Absolutely. I agree with that 100%.
It's very interesting when you see that side of people's lives, what you learn about them. So, in any case, meanwhile, this video we just went up by like 5 viewers.
Just 5 stuff? Really?
Moving along, we've got payroll liabilities on the balance sheet.
Yeah.
And,
there's my favorite, other.
When I look at this, but when I look at this, there's two things. First of all, if I don't see payroll liabilities, then I jump right over to the chart of accounts and I check there, because it could mean one of two things. Either it's there and it's being booked 100% correct and it's zeroing out with every payroll that I book, which, depending on how the liabilities are paid, very often is the case, right? Very often it's the case that by the time I book the entire payroll for a pay period, the liabilities zero out. So it's possible it's there and I just don't see it.
Chances of that being true are like 1%.
Oh, I have clients. They pay them immediately.
Yeah,
they've dated the tax wrong. They may date it. Well, the default in the payroll program is really wrong. It'll have the withholding date way down bottom left, and then there's the date of the say the e-pay or the payment, and they need to be the same. Why doesn't it default to the same? So they go down. They say, well, take my taxes out next week, on the due date, but they don't change the date on the check or the e-pay. So it clears the balance sheet, 2 days before the payroll.
That's because a lot of times the payroll companies pull the money out in advance. So yes, and it gets booked on the date that the money was pulled out.
Third party, yeah, that's exactly. They'll do it immediately.
Yeah. So and there's a few ways to fix that. One is you can do it by entering a bill for the payroll, so that you can show the bill date, and then when they pull the money out, show that as a payment on the bill. That's one way. Because this way the bill date will drive when the expense shows up and when the liabilities show up. The only time I ever really care about this, though, is at year end, when I need to have the right accrued payroll amounts on the books. Usually during the middle of the year, I don't really care. That's just me.
It depends on the timing and who's getting the financial statements.
Well, sure. But so ultimately, and then when I do see balances in payroll liabilities, if they're small like this, that starts to sort of give me assurance that there's a good chance it's right. But obviously, I'm not going to stop there and be satisfied. So we have to confirm. And at this point, usually what I have to do is I'll ask the client to give me the last, all the payroll reports for this year so far, or something like that, so that I can just confirm and dig in. And in a perfect world, what I'll see if I just click total payroll liabilities here, or double click it, that's going to give me a total by account, and I want to see that this is periodically zeroing out, ideally. Again, there may be cases where some of the taxes are being paid quarterly, so it will never quite zero out, but you can usually eyeball it within an account and figure out that as the payment goes out, as of a particular point previous in time, the payment amount matches with whatever the running balance accumulated to.
Or so at this point, extend the date range and make sure that they, paid it. They may have paid it dated in the future, and you're okay.
Yep. Now here's a good example. See where there's a liability check that looks like it's clearly coming out before the payroll got booked, right?
Yep.
So this came out on the 15th, or it's just the way it's ordered because look, they're all on the same date, but QuickBooks just orders it based on, I think, amount first within a given date. So that's that's where you'll see something like this. So what I do is I look for when does the date period stop. So here I get to the last one on February 15th, and I see, okay, here we come down to 197.06. So there's probably like a quarterly payment coming up that's going to zero that out. But then as I look down, I notice, oh, we keep coming back to that 197.06. That could indicate a problem. That could indicate that there's something that never did quite zero out properly.
Mm-hmm.
Now, I always set up the different kinds of payroll liabilities in separate accounts. So I'm never commingling, say, a 941 that's due semi-weekly and a unemployment that's due quarterly.
See, and what I do, and this is just from my own experience, is I have found that having all the different separate liability accounts, one lends itself to creating problems because people will post things, they'll mispost things in the wrong liability account when they're posting the payroll, especially if it's a third-party service. So I have found that I prefer to have one payroll liabilities account, run it all through there, and see that that zeroes out.
If it's something like ADP or a third party, yeah. If they're doing their own payroll, as long as it's set up properly in the beginning, you're not going to have that. Yeah.
Right. So, and it just depends. And so there's no right or wrong here. It's just a question of what, in your experience, kind of leads you to do what you do. At the end of the day, the bottom line is what we do need to make sure of, and where there is a right and wrong, is we need to make sure that total payroll expense is correct, and we need to make sure that the liabilities are taken out at the right amount, which, and then we need to make sure that when the tax payments go out, they include the proper split between the employer's share of the taxes and what liabilities were withheld. So that ultimately what that means is the liabilities do need to zero out at some point. Even if there's a slight timing difference, we should be able to tie out that difference, where it is and when it happens. And that's what we want to verify when we're going through. And here again is a perfect example of a significant area of the balance sheet that affects a significant area of the P&L. Because this goes to our salaries expense, this goes to our payroll taxes. If it's involved, this could be a pension expense. This could be, other retirement type expenses that might, go along with the company. So this is such a critically important area to make sure it's 100%.
You have to tie it down. One other thing that I find is, say they pay a penalty, and the default on the check goes to a payable account, and that penalty is, instead of being expensed, it's whacked out the liability account. That's another common one.
Yep. Yeah, so that's how we roll with the liabilities. So again, just to make sure that this is clear, if there are no liabilities on the balance sheet when you run it, you got to go to the chart of accounts and see what's going on in there, because oftentimes you'll find that it's in there and it's just zeroed out as of the balance sheet date. And even if it's zeroed out, you want to make sure it's zeroed out for the right reasons. So you never want to just
we know what that is. That's somebody set up a new payroll code and blew past the setup.
Yep. Yep, and now we have line of credit. So often when I see a line of credit, all I see are payments to principal. And again, the related area on the P&L, interest expense, right? Do I have interest expense?
I reconcile line of credit account same way I reconcile credit cards and bank accounts.
Yeah.
Same here. Yeah.
Have to. You have to. It's a lot of times it should be an easy reconciliation because a line of credit, no, because it's revolving. So usually there are drawdowns and then repayments. In fact, with a line of credit, banks want that. They want to see activity on a line of credit. So that's the other thing to think about is when you're looking at a line of credit, you want to see that they are frequently borrowing and paying back, because if not, they could potentially be violating one of the covenants of the loan agreement with the bank. So those are the kinds of things that we can look out for, to help the client make sure that they don't get into trouble with this sort of thing. Because a lot of the natural thinking is to say, well, as long as I'm paying it off, why should the bank get mad? And it's like, no, the bank wants you to use it. If it's usually in the covenants that they have to see activity on there because they want their interest on it. Let's face it.
Yep.
So I agree, Gina. Line of credit definitely should be reconciled. And then we have our equity section. Now, we kind of talked about this originally at the beginning last week, so I won't spend too much more time on this.
You know what would be helpful, Seth, on some of these areas? If you have a column for the last fiscal year end and then a change column, and you can look at something like equity and then see that, oh, it's obvious that they never zeroed out the draw account at the end of the prior year, or distributions or whatever.
Now, it's interesting you bring that up. Because it's funny, I just had this discussion with somebody on YouTube. Should we close out the draws to retained earnings or shouldn't we? The reality is, if you look at it from the standpoint of a publicly traded company, it should not be closed out to retained earnings. That area represents additional paid-in capital and should be left in as a permanent difference.
If it's additional paid-in capital, yes.
But shareholder draws and distributions, that's what they represent. That really is additional paid-in capital and then capital that they withdrew against that additional paid-in capital.
Unless you're an S-corp, it could be a distribution.
As an S-corp, it'd be a distribution, but even then, as an S-corp, more important not to close it out to retained earnings, because for an S-corp, they have to be exactly proportionate to their percentage ownership in that S-corp. So you have to leave it permanently there so that you can make sure that that relationship is maintained. There can be a tax implication if the shareholders' draws are not proportionate to their percentage ownership in an S-corp. And I learned that because I ran into it a few years back with a client where we weren't doing that. We didn't keep them even, and we got nailed on it by a CPA who was looking at the books and looking at potentially buying this company. And they said, why isn't it even? And I had to go back and post entries to make it. They were 50-50 owners, so I had to make them 50-50, and the difference is we just put into a loan account. So for an S-corp, you definitely don't want to be closing that out to retained earnings.
See, I make sure that the distribution account matches the tax return before.
Which is right, but at the same time, we're also supposed to be making sure that the distributions for the shareholders are proportionate to their ownership in an S-corp.
Yeah, but if I can't glance at the net change, you're looking at the percentage change, but the net change for the year and make sure they're neck and neck for the year.
Okay, you can do that.
Yeah, just a different way. Well, I may let the tax accountant track the AAA account, say, in their records, and not so much on financials.
So for when I'm doing the books, and if nobody's sort of asking me to do anything different, then I don't close out the shareholder withdrawal and contributions accounts to retain earnings. I leave them in there. And in fact, what I like to do is within, like here we have in the sample, we have Deborah Wood's Capital. Within that, I would have one account for the distributions, one account for the contributions, because I also like to see from an analytical standpoint, since day one in time, here's everything they put in, here's everything they drew out, and then, of course, the net rolls right up to their, their parent capital account level, so that it's very clear to see.
If they're a sole proprietorship or a partnership or...
No, even on an S-corp.
Oh, you're talking about it, yeah. But I'm just saying you have to know what kind of entity it is. You can in different ways, yeah. But
I still structure it the same way. The only thing that changes from entity type is the nomenclature, right? So it won't be...
If I've got 20 stockholders in an S-corp, I'm not going to, it's a judgment call file by file.
Sure.
If there's one or two, you don't want your balance sheet to be 4 pages long.
Right. No, but to me, and again, this is just based on our experience and the clients we're dealing with and what they want and the other people involved. But for me, even with 20 shareholders, I would still want to do it that way because I'd want the shareholders to be able to see kind of against one another where everybody's at. A partnership, it becomes almost even more important because the partners need to know what they contributed, what they paid in to get into the partnership, if that's the case, and so all of that, I like to leave the differences in here permanently and have it detailed like that, if possible.
Mm-hmm. And then the tax accountant will have to go to the transaction report to find out what this year's distributions are.
Well, yeah, or you just back out of what it was as of the beginning of last year, right? So you look at the previous year comparison. Right here, there is no previous year, but yeah, and you can take the dollar difference, like you were saying earlier, to see what it is just for this year, to see what the change was.
And that format is really handy too for looking at fixed assets and glancing to see if they've got $24 change in the fixed asset account, and you go, well, you put a supply up there, yeah.
Yep.
That's a handy.
And then the other thing is, the newer versions of QuickBooks, I've got these little arrows here. So if I want to condense, I can, right? So I can condense her capital account by clicking the little arrow to kind of zip it up. So that helps. If I have a detailed equity section like this, I can still show it, in a way that's more sort of consolidated. And then, of course, the other thing is that we mentioned at the beginning of last week in the first session of this is to make sure that retained earnings ties. You reconcile retained earnings almost in a similar manner to the way you would reconcile a bank account. You say, here are my beginning retained earnings, here's the net income from this year, the net of the shareholder activity for the year, add it all up, and you get to the right ending retained earnings balance, and it should agree.
And make sure total assets equals total liabilities, and if it doesn't, we've got a data problem.
Well, total liabilities plus equity. But yeah, it's usually going to with QuickBooks, but I have seen some cases where something weird happened with the data and the balance sheet was actually out of balance. So you do definitely want to double check that.
Mm-hmm.
And then just very quickly, we have literally like a minute left, but to review the P&L accounts, it's not going to change from one account to the next in terms of how you're going to do it. The income, I'm going to run a series of reports, sales by customer, whatever is appropriate to look at in order to make sure. And sometimes what I'll do is I'll just double-click the total income, and I'll total it by customer and look at this again with the owner of the business and say, hey, does this look right? Did you gross $34,500 from Dunning's Pool for the lost wages store? Right, and I'll ask them to confirm that if it looks right. If the owner seems sketchy about whether or not it looks right, then I'll ask them to look into it, because my experience has been that they have an uncanny sort of way of knowing when something doesn't look right, even if they don't know why it's not right. My experience is if the owner says it doesn't look right, there's probably something wrong. The expense accounts, in a similar capacity, but on the flip side of that coin, I'm going to go in and double-click a number, and I'm going to total it by vendor. And that way, and this is not a good example because there's only one transaction, one payee. Let me change this back to this fiscal year, then we'll get more meaningful information. So I go to like a repairs and maintenance and total by vendor. Sometimes you can total by payee because sometimes the expenses might be coded to a name that's in the other names list, so you want to be careful about that. But so you can do it by payee to be safe. And again, so these payments for repairs, this is interesting. They're paid to her, to the owner, Deborah Wood, who we saw in the equity section. So that's potentially a red flag. Was it really for auto repairs? Presumably she's getting reimbursed for repairs she paid for out of her own pocket here. But still you want to watch for something like that. Is it really an auto repair that's a business expense, or is she just taking distributions out and trying to get a deduction for it?
Yeah, and then she's just auto repair. Sounds like a good place to stick it.
Well, sure. So same kind of thing throughout the whole rest of the expense accounts, is just going into each account and totaling it by payee to see, okay, and just look, do the names line up with the account, with the expense type, right? We're in dues and subscriptions, so I see, all right, so this is an association, that fits, right? And then, well, this just says professional subscriptions, but the payee is professional subscriptions? That's weird. Do I pay a professional subscriptions companies to sign me up for subscriptions? Because that's what that sounds like. So, like the message I have to bookkeepers on this is question everything. Question everything. Like, what? Come on.
Through bank feeds, and that's how it was listed.
Which could be, but I want to know that. I want them to tell me that without me leading them to the answer. You know what I mean?
Mm-hmm. And if you go to like conferences and fees and it's not a whole number, that's a clue that maybe they're mixing in meals and travel.
Mm-hmm.
Yeah.
And we want to make sure that Ryan isn't like Deborah's brother for Ryan Professional Seminars.
Doesn't go below $100 limit for 1099s.
Mm-hmm.
There we go. So anyway, but that's basically it. That's how we review and clean up the file, and a lot of it, like I started to say last week, I think rests on doing it together with the owner, with the client, because there's gonna be a lot that they can answer that we couldn't answer just by ourselves. We just never know. So that's the process. For those of you kids watching at home, if you have any questions, post them. We'll be happy to answer them, or go into our Facebook group. You'll find us on Facebook at Accountants, Bookkeepers, and Business Owners, and join the group and ask your questions there. There's great dialogue going in there right now. In fact, next week maybe what we'll do is we'll address the topic that seems to be recurring there, which is it seems like there's a lot of bookkeepers who are posting questions because they've just moved, for example, to a new area, and they want to know how they can get their bookkeeping practice started up. And so I think that'll be a good topic for next week, is how do I grow my bookkeeping practice? How do I get it started? How do I grow it? Maybe I'll even be able to get Eric in here for some comments from the marketing side of things.
Let's give a shout out to Lucinda Lentz.
Lucinda Lentz, thank you so much for the mention in QBO chat this week. Anything else before we go? Parting words, Gina?
Parting words, come join my hangout later today. It'll be anything goes.
Anything goes. 2:30 Pacific, 5:30 Eastern.
See you there.
Fun
See you
time.
there.
See ya.
Bye, Peter. Peter's going to come back to a blank screen. Bye, Peter.
Bye, everybody.